how does tax affect us over the long haul? We're going to use an example from before where Sarah invests $30,000 making a rate of return of 15%. Now, if we were to say that she is being taxed at 30% marginal tax rate, meaning on her last dollar, she's getting taxed 30% of that, we're going to say that the 15% rate of return is coming in as income or as interest, and therefore it would be fully taxed at the 30% each year she makes it. So in the first year, she invested $30,000 and she makes 15% minus the tax. So this would have been $4,500, but because she had to pay tax, it ends up only being $3,150 that she's able to retain, that she's able to keep at the end of the year, because the rest she had to pay as tax. So at the end of the year, she's got $33,150, which is the $30,000 plus the $3,150. And then year two, the 15% is compounded on the $33,000, and then the tax is taken off. And this just keeps going on until, let's say, retirement age of 55, she would have almost $1 million. What's cool about this is after-tax dollars. Now, what if she didn't pay the tax? What if she deferred the tax, which means she will pay tax eventually, but not right now? So deferred tax, what is that? Well, in real estate or when you buy a stock, you don't have to pay tax on that, generally speaking, until you sell it. Then it would be growing at the full 15%. And as time goes on, at 55, she would have almost $4 million. Sarah had to pay on the $4 million minus the $30,000 because that was already after tax. But we'll just say $4 million straight so we can keep the numbers really simple. She has to pay 30%. So if it was deferred and she had to pay full tax on this, then she would have 70% left, which is $2.8 million. And I know some of you are screaming and saying, yeah, but her income is higher now because she's getting this huge sum at once, so she's not going to be paying 30% tax. She's going to be paying more like 50% tax in my area, or 40%. So we'll just do that. We'll say the $4 million at 50% tax, which means she has 50% left. It would be $2 million, which is still double what it would have been if she was paying tax every year and not deferring that. But in this case, we're talking about real estate or stocks, and usually there's a capital gains exemption, which means you would pay half of the tax or pay tax on half of it. Sometimes there'll be a capital gains exemption, but in this scenario, just to keep it super simple, we're just going to say that the exemption is for $1 million, and that's the most you can use for your capital gains. If it's $1 million, she only has to pay tax on half of it, which is $500,000, which means at 50% tax rate, 50% she keeps, $250,000 would be the amount of tax she pays on the $1 million, plus she still has $3 million she has to pay tax on. So she would pay a full amount of tax of 1.75, which means if she had made $4 million, she would have 2.250 in increase instead of just under 1. So you can see that the deferred tax is the biggest part of tax savings because it's getting to compound year over year. And then you do get a decent amount of savings, almost $250,000 from a capital gains exemption, but the deferment is the biggest piece. This is why buying real estate can be such a huge investment. And I say this is why, but there's so many reasons, and hopefully I've been showing you that through this short series, that saving tax is one of the components that makes investing in real estate such a powerful tool.